Hey everyone, welcome back to Finance Sphere. There's a major story taking over the crypto space right now, and it's about to significantly reshape crypto regulation in the US, the Clarity Act. Behind the scenes, Washington and Wall Street are locked in a quiet but serious turf war. So, what exactly is in this bill that has Wall Street watching closely and Capitol Hill divided? Today, I'm breaking down what the Clarity Act actually is, where it stands right now, and the critical upcoming timeline. On top of that, we'll also dive into how the UK is capitalizing on this exact political gridlock in the US, moving aggressively with an offshore strategy designed to pull digital assets right into their own territory. Let's get straight to the point. Here are the four core pillars of the bill. To start, it aims to end the regulatory turf war we've been watching for years. For the longest time, the SEC viewed almost every crypto asset as a security. This bill would significantly limit that sweeping authority, transferring much of the primary jurisdiction over to the CFTC, which operates on clearer, principles based rules. A textbook example of the old approach is Ripple. As you know, the SEC sued Ripple, claiming XRP was an unregistered security. Because of that legal cloud, XRP missed out on the major bull run, its price suppressed for years while stuck in litigation. The Clarity Act aims to draw a clear line to make sure we don't see another Ripple situation. If this passes, jurisdiction over a large chunk of tokens will migrate from the SEC to the CFTC. Because this will increase the CFTC's caseload, the bill calls for a budget expansion to hire more staff. Naturally, this has triggered a political fight over whether these new positions will be filled by Republicans or Democrats. The second pillar, and this is where things get interesting, is how it handles stablecoins. The bill requires issuers to back their stablecoins 100% with high quality liquid assets, specifically US Treasuries or cash. On the surface, it looks like consumer protection. Here's why it's much bigger than that. The US is trying to protect the dollar's status as the world's reserve currency. By encouraging stablecoin issuers to buy US Treasuries, the government effectively secures a steady, built in buyer base for national debt. In effect, every new stablecoin issued creates another buyer for US Treasuries. The third pillar establishes developer protections and a regulatory framework for DeFi. But there is a major sticking point: defining the scope of legal liability for developers. The initial draft exempted pure open source developers, those who don't custody user funds, from being classified as financial intermediaries. However, regulatory hawks like Senator Elizabeth Warren are pushing back. Their argument is simple: you can't just deploy a smart contract, claim you don't hold the funds, and get a free pass. They want to mandate standard KYC and AML compliance directly at the protocol level. Fourth, the bill amends federal banking laws to allow commercial banks to handle digital assets for lending, settlement, and custody. If these reforms go through, it will change the banking ecosystem. Up until now, even if banks wanted to custody crypto, SEC accounting guidelines under SAB 121 forced them to list those safeguarded assets as liabilities on their balance sheets. But if the law changes, Tier 1 banks can roll out crypto custody services, creating safer, regulated options for clients. This means conservative institutional capital is expected to move into the space, boosting the real world asset tokenization market. Essentially, we could see a future where a single financial app handles everything from retail payments to trading tokenized assets. So, when is this legislation actually going to pass? Here's why the next few weeks matter. August 7th, the day Congress goes on its summer recess, is the key window. In a best case scenario, the Senate must return from recess, clear procedural votes, and pass the bill by mid July. But if it doesn't pass by August 7th, the bill might be dead on arrival for this year. From mid August to mid September, Congress is in recess. Even when they return, Washington shifts entirely into campaign mode for the November midterms. Right now, prediction markets like Polymarket are pricing the real-time odds of the Clarity Act passing at 38%. Since the implied probability is quite low, what exactly is stalling the bill? Let's look at the main friction points. The first major hurdle is the debate surrounding President Trump's financial disclosures. On July 1st, reports revealed that a staggering $1.4 billion, accounting for about 65% of his total income, came from digital asset licensing. Democrats are raising concerns about potential conflicts of interest, arguing that the administration is shaping policy to benefit personal ventures. The other major battleground is a classic financial turf war. Traditional banking groups, particularly the Independent Community Bankers of America, are lobbying hard against the bill. The concern comes down to a loophole regarding stablecoin rewards. While the draft bans traditional interest on stablecoins, it allows issuers to distribute rewards for transactions. Why do banks care so much? They warn that if stablecoins offer yield-like incentives, trillions of dollars could leave commercial bank deposits. At its core, this is a classic battle over market share. The crypto industry pushing for innovation versus traditional banks protecting their deposits. Looking at the big picture, Capitol Hill is now juggling several battles at once. Because of this, the SEC has already established a backup plan, preparing to issue its own guidance even if the bill fails. Instead of waiting for Congress, the SEC has already introduced a four-tier token classification framework to clarify when an asset is a security. They are also proposing an administrative rule called the Startup Safe Harbor, which would grant blockchain startups a registration exemption of up to $5 million for up to 4 years, provided they properly disclose their white papers. Furthermore, they are introducing a decentralization stamp of approval. Once a project becomes sufficiently decentralized and the founding team steps back completely, it will be recognized as outside the regulatory scope. But the biggest change for Wall Street is how they're handling bank custody. Previously, the SEC's guidance under SAB 121 penalized banks for holding crypto. The SEC is now moving to replace SAB 121 with SAB 122, applying standard accounting principles instead. This finally clears the path for traditional banks to offer crypto custody without balance sheet penalties. Now, the real reason the SEC is moving so aggressively with this backup plan isn't a secret. It's because they see what's happening globally. While the US is paralyzed by political infighting, other nations are moving fast to hijack the market. Specifically, the UK is seizing this exact moment to drain digital asset liquidity straight into London. While the US remains locked in this legislative stalemate, the UK Financial Conduct Authority recently passed a sweeping crypto regulatory framework. Under these new rules, the FCA confirmed that for highly liquid, verified digital assets like Bitcoin, institutions will be subject to a flat 40% net exposure prudential requirement. Essentially, the UK is positioning itself to build a digital version of the historic Eurodollar market, and they're doing it by drastically lowering capital requirements for institutional players. This completely slashes the amount of idle capital a fund has to lock up. As a result, major hedge funds and prop trading firms, exhausted by US regulatory gridlock, are rapidly setting up shop or establishing paper companies in London. They aren't physically moving their crypto wallets, but on paper, they are shifting their trading books to UK entities to take advantage of the rules. This looks exactly like a modern reenactment of the 1960s. Back then, the US introduced Regulation Q, which capped interest rates at commercial banks. Capital naturally fled to where it could get better returns, and London welcomed it with open arms by declaring that US dollars traded in the UK wouldn't be subject to British banking regulations. That gave birth to the massive offshore Eurodollar market, cementing London's role as a global financial superpower. Today, the UK is running the exact same playbook, using a lean, competitive regulatory framework to pull digital assets and Bitcoin liquidity right into their orbit. To wrap things up, if Congress moves quickly and passes the Clarity Act before the deadline, it will be a major positive for the industry. However, the market needs to manage expectations, as a delay could trigger a short-term correction. Even if the bill fails this year, the regulatory landscape is shifting, and crypto is steadily integrating with traditional finance. The convergence of these two worlds is already underway. We might not get a legislative resolution before August 7th, but institutional adoption is happening regardless. That's all for today's episode. If you found this breakdown helpful, please make sure to subscribe, like the video, and turn on notifications. Thanks for watching, and I'll see you in the next one.